Hey, my name is Bruce Simmons. I'm the reverse mortgage manager with American Liberty Mortgage right here in Denver. And today I want to talk about interest rates with reverse mortgages, specifically the home equity conversion mortgage, which is just the name for the FHA insured reverse mortgage. And what we're going to talk about is the interest rates and how they're calculated, as well as what is the effect when rates go up or down on you, the borrower. So let's dive in here. So first off, I want to talk about that there's actually three different options with interest rates with reverse mortgages. There's a fixed rate, there's a monthly adjustable rate, and then there's an annually adjustable rate. I'm not going to get into the details of the fixed rate, but suffice it to say that the fixed rate option does not have all the flexibility that a adjustable rate reverse mortgage does as far as it goes, because it requires you to pull all the money out in one lump sum, and then you're charged interest on money that you may not even need. And then also too, FHA has limits on the amount of money you can take out in the first 12 months of the loan. And since the FHA fixed rate loan does not offer lines of credit or a monthly payment option like the adjustable rate does, it's just not nearly as flexible. So today, the focus of our topic here is going to be on the adjustable rates. Specifically, we're going to look at the monthly adjustable rate. That's the one that 85% of the loans I closed last year in 2021 had adjustable rates, the monthly adjustable rate loan. So just also too, for a point of reference, today's Sunday, it's March 6th. Okay, we're going to be looking at rates going back and what they might do going forward. All right, so let's dive in here with all the rates. Basically, what I want to explain is there's two different interest rates with the adjustable rate reverse mortgages. There's something called the initial rate, and that rate is the actual rate you're charged once the loan goes into effect. There's also something called the expected rate. The expected rate is the rate that we use to determine how much we can loan you. That's called the principal limit. We don't keep things simple with reverse mortgages. We like to change the names. So the principal limit is the maximum amount that we can loan you on a reverse mortgage. Keep it that way. And I'm going to show you examples here too. So it'll clarify once you take a look at these examples. The expected rate is based on an index. All adjustable rates have an index. Like if you have a traditional HELOC loan, a home equity line of credit, it might be tied to prime. That prime rate is the index. And you might hear somebody say, yeah, I've got prime plus 2. Well, 2% is the margin. So their index is prime plus 2 is the margin. So their interest rate, the rate they're charged, is the prime rate plus 2%. With reverse mortgages, we use the U.S. Treasury index. So the initial rate that which is the rate you're actually charged, is the 1-year Treasury index plus whatever the margin is. And for the examples today, just to keep this number simple, I want to use a 2% margin because it's easy to add. 2 plus 1.25 or whatever it may be is simple. So we're going to use that. But what we do, the way reverse mortgages calculate the interest rate is we look at the previous week's interest rate. So the U.S. Treasuries adjust every day. Every single day, they're constantly moving up or down. But the close of each day, we take the past week's average. And so the last 5 days, or if there's a holiday, it might only be 4 days. And we're going to look at that. So let's jump into that now. I want to take a look and see if I can do this without messing up here. This is the U.S. Treasury website. So right here, the U.S. Treasury website. Okay, and what we're doing is we're looking at the daily yield curve. Okay, notice there's 1 month, 2 month, 3 months, 6 months, 1 year, 2 years, 3 years, 5 years, 7, 10, and 20 and 30. The effective rate, which is the rate we use to determine how much money we can loan, is based on the 10-year Treasury index. Okay. The initial rate, which is the rate you're actually charged, is based on the 1-year index. What we do is we take the previous week's average of these rates. So for example, let's go back, since this only goes back to Tuesday, March 1st. We're going to look back on all of 2022. Okay. And what we're going to do is we're going to increase this in size so we can see it. All right. So we're looking at the 1 year. Well, let's look at the 10-year. This is based on the expected rate. So this is the rate we use to calculate how much we can loan you. The higher the interest rate is, the less money somebody qualifies for. Okay, so we want this rate to be as low as possible. And we've enjoyed these great low rates for years, which unfortunately they're artificially low. They're not true market rates. The Federal Reserve has been keeping the rates low for the economy. Okay, and unfortunately they've kind of backed themselves into a corner here. You can see at the beginning of the year, the interest rate was 1.63. That's the 10-year average. Let's scroll down now. And you can see it actually went up to like 2.05 here in February and 2.03 there. And then it kind of came down. Then it started going back up again. And now it's coming back down. So last 5 days, what we're looking at is Friday, it was 1.74. Thursday, 1.86. Wednesday, Tuesday, and Monday, 1.83. We take those last week's average, or those last week's totals, and we divide them by 5. And that gives us the rate, or the index is now 1.80. Okay, that's what we're basing the rates on for next week. Our rates are effective from Tuesday through Monday. Okay, so if you're applying for a loan tomorrow, Monday, March 7th, your rates are going to be based on the previous week's average. Okay, so which was 1.97, 1.96, 1.99, and 1.94. Now there's only 4 days because President's Day was that week. So Monday, the Treasury didn't post a rate. So we took those rates and they averaged 1.97. Notice that this week's rates are much lower than last week's rates, which is a good thing. That means the rates are dropping. So it went from 1.97 down to 1.80. This is the rate we use to calculate how much we can loan you, remember. Okay, let's look at a couple of examples. Okay, here's an example of somebody that's 70 years old, and they've got a $500,000 value. This is something called the comparison page. What I always tell people is when you're shopping for rates, you want to look at the margin. The margin is the difference between the index, which is the 10-year Treasury index, and the rate you're charged. The expected rate, again, is based on the 10-year Treasury index. So that rate last week was 1.97. Next week, it's going to be 1.80. Now, we round off this to calculate the principal limit. See, because what we do, we take the age of the youngest homeowner, this expected rate, and the value, the home value of the home, up to what we call the maximum claim amount. And as long as your house is below $970,000, $970,800, the maximum claim limit doesn't come into effect. In this video, I'm trying to keep it as short as possible, so we're not going to get into that. Based on those three factors, though, this expected rate, or the age, the expected rate, and the value, we come up with something called the principal limit. That's the maximum loan amount. That's the amount we can loan. So in your case, if you're 70 years old and you have a $500,000 home, and you're applying for your loan on Monday, the 7th of March, then you're going to get $261,000. Of course, we subtract closing costs from that. Okay. But let's say you waited till Tuesday, the 8th of March. Now, the effective rate, now what I did is I lowered the margin by 0.25% because we round off to calculate principal limits. We round off to the nearest 1/8%. And a 1.8 margin is effectively a 1.75, okay? So we take the margin plus the 1.80, and we come up with 3.80, which rounds off to 3.75. And in order to calculate this before the rates actually change, I have to give you, it's a 0.25% lower than what we were last week, because last week it rounded off to 2%. 1.97 rounded off is 2%. 1.80 rounded off is 1.75, okay? Just so you understand that. So basically, the net result is it's 0.25% lower. So what I did is I lowered the margin by 0.25% here to have that effect. That's hopefully that is not too confusing for you. Essentially, the bottom line is about an $8,000 difference if you apply for your loan on Monday, March 7th compared to Tuesday, March 8th. If you wait till Tuesday, you'll get an extra $8,000. And because what we do is we lock this expected rate effective as of the date of the application. Okay, so that rate's locked as of the date of the application. Now, the initial rate is not locked. We cannot lock that. FHA does not allow us to lock that rate until right before we close. Basically, once we get the final approval, then we can lock the rate and we schedule the closing. So that rate's going to continue to adjust. But this rate is locked, and that's the one that's important. What I tell people is the expected rate is the rate we look at before we close the loan, because that's the one that determines how much we can loan you. The initial rate is the rate we look at after the loan closes. All right? So that's the rate you're actually charged. Once that rate goes into effect, once we close the loan, you're charged that interest rate. Hopefully that makes sense. I know I kind of jumped around a lot here and wasn't real clear on how we calculate that bottom line there, but that's the best I could do at this point. I wanted to explain that it's not, when the rates change, it's not a greedy lender saying, oh yes, we need to charge them more. No, it's based on these actual numbers here, what we look at to calculate what the actual rate is. So please feel free to call me. Visit my website at reversemortgageradio.net or feel free to call me at 303-467-7821. Thanks so much for spending the time to view this video, and I hope it clarifies some things for you. Have a great day.